This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you in part by
TheStreet.com. Founded by Jim Cramer, TheStreet.com is an independent source for stock market analysis. Cramer's Action Alerts Plus service is home to his multi-million-dollar portfolio. You can learn more at TheStreet.com/NBR.
Silver lining, not as many jobs were created in January as hoped, but the unemployment rate dropped, and experts are saying that trends are actually encouraging.
From coast to coast, why are Californians thousands of miles from the harsh East Coast winter also feeling the chill?
And high risk, high reward. If you're looking to invest in companies with big growth potential, our Market Monitor guest tonight has a list of stocks that are relatively young and newly public. All that and more tonight on Nightly Business Report for Friday, February the 7th. And good evening, everybody. I'm Bill Griffith. Tyler Matheson is off again tonight.
Good evening from me as well. I'm Susie Garrett. American businesses didn't do much hiring in January. Only 113,000 new jobs were added to payrolls. The words used to describe today's jobs report: disappointing, anemic, and even awful. But Wall Streeters saw a brighter side, saying it wasn't so terrible. After all, the unemployment rate fell one notch to 6.6%. Surprisingly, stocks rallied, closing positive on a week that started with the Dow plunging 300 points on Monday. Here's a look at today's closing digits. The Dow shot up 165 points, the Nasdaq surged by 68, and the S&P added 23. Hampton Pearson takes a closer look at this latest jobs report and some encouraging trends behind the numbers.
For a second straight month, leading economists and market analysts didn't know what to make of a government report telling two different stories about the job market. Employers added fewer workers to payrolls than expected, but the unemployment rate dropped again.
I think it's a lot of weather is still in this number, and it's in the 30,000 decline in government. I mean, something odd is going on there.
I think the thing to keep in mind is this divergence where you're getting plus 600,000 employment on the household survey and you're getting only plus 100,000 on the establishment survey is going to be a big problem.
While the January headline number of just 113,000 jobs is weak, trends underlying the employment rate decline are encouraging. In January, the number of people with jobs increased by 638,000. The labor force increased by nearly 500,000. And the number of people out of work 6 months or longer fell by 232,000. All are indicators, economists say, of new businesses and jobs being created, but not yet reflected in surveys of employers.
What we could be seeing is new business formation beginning to start to gain some momentum, which has been really absent much of this recovery. We don't know that for sure yet, but there's an inkling that it could happen.
Part of the new business and job creation story that is going below the radar, job incubators like 1776 in Washington, D.C. Formed less than a year ago with private funding, corporate partnerships, and a boost from the D.C. government, it's been a launching pad for more than 200 new businesses.
There are a lot of people who have either lost their jobs or their jobs are at risk that are looking at entrepreneurship. And entrepreneurship really crosses any sort of economic situation, whether we've got an up economy or a down economy.
One of the success stories is RideScout, a technology platform that tells you not only how to get around, but what modes of transportation are best. Its target audience are millennials, one of the fastest growing population groups in the nation's capital, many of whom don't have cars. In just 6 months, they've hired 20 full and part-time employees and expect to double that workforce in the near future.
This company could scale very quickly, and we believe it will. And some of the older employees really love the opportunity to be part of a team that's going to scale and be explosive in its growth.
Make no mistake, doing a startup in today's tough job market is risky. But creating new jobs and new businesses has always been the key to taking any economic recovery to the next level. For Nightly Business Report, I'm Hampton Pearson in Washington.
And for some companies looking to hire more employees, a big challenge to growth and profitability is finding the right workers, like skilled welders or machinists. Mary Thompson reports tonight on the efforts by one company, Friedman Seating in Chicago, on where the jobs are.
120-year-old Friedman Seating is growing like an adolescent.
Over the past 10 years, we've averaged about 10% compounded growth per year.
As with a teenager, the growth spurt for the maker of seats for buses and delivery trucks brings some unwelcome problems. After adding 100 workers last year, President Craig Friedman wants to hire another 35 skilled workers this year, if he can find them.
There's been a bidding war for these workers.
Those workers include welders and people trained to operate computer-guided machines. Friedman says smaller manufacturers, along with richer Chicago-based multinationals, sometimes poach these employees. So the shortage of workers for these high-paying jobs, which can fetch up to $12 to $25 an hour, is squeezing Friedman's bottom line.
We have to use a lot of overtime to get the work done. We have to outsource a fair amount of work that we don't have the capacity to do because we don't have the skilled labor to do it.
To find needed workers, Friedman's tapping two sources, a local high school and a Chicago-based nonprofit called the Jane Addams Resource Corporation. JARC, as it's known, trains displaced adults for industries offering living wages and upward mobility. Here's Executive Director Guy Loudon.
We don't run it like a traditional school where people are sitting in classrooms working out of books. It's a job. Our lead instructor functions more like a plant manager.
Welder Valerie Galvin trained at JARC and after just 8 months with Friedman Seating sees a future after years of dead-end jobs.
I actually feel like I'm in a career path. You know, I'm still in an entry-level welding position, but I have the skills that I need to improve and move forward with that.
Friedman Seating also moving forward with other local manufacturers to address the shortage of skilled workers. It's part of a group overseeing Austin Polytechnical Academy, a Chicago high school training students in job-ready manufacturing skills. 19-year-old brake press operator Torres Hughes is one of the 2 Austin graduates Friedman has hired.
I feel like I was introduced to something that can change my life in the future as well, can really mean something to me and my family. And I love what I do.
Friedman making seats that transport passengers and their employees too. For Nightly Business Report, I'm Mary Thompson in Chicago.
Joe Davis says today's jobs report was bad, but not so bad, and he's hopeful about the outlook for the U.S. economy. He's the chief economist of Vanguard. This is the giant mutual fund company. So, Joe, you sound like you're a glass half full kind of guy, but tell it to us straight, because we've gotten so many mixed signals on the economy, and everyone wants to know, is the economy getting better or worse?
I think Susie Hampton really hit it on just the nail on the head. I think it's marginally improving. I think we're confident in the trend, the underlying trend in the economy, which is modestly stronger growth as we continue to proceed into 2014. There were some disappointments today in the number in the business survey, a little bit weaker than expected. There may be some weather distortions at play. But nevertheless, I think we continue to see a gradual tightening of the labor market despite a significant slack. So I think the progress is good. I would have liked to have seen a little bit stronger job growth today.
More than one person today, Joe, said to me, we need to get used to these lower job growth numbers, that this is the new normal in this economy. Do you agree?
I think generally speaking, yes. I mean, we've been of the view that trend growth, Bill, is closer to 2% and job growth around 100 to 150,000 jobs per month. In other words, to make a dent in the so-called slack or gap in the economy. And so I think we have to look at a lower barometer or speed limit for the economy. So I think that said, these numbers are at least consistent with trend, slightly better than trend growth, but it certainly pales in the comparison to what we may have seen 20 or 30 years ago. So
what do you think Janet Yellen, the new Fed chair, is going to say about all of these trends going on with job growth? She's going to be testifying in front of Congress next week. Yes. And everybody's wondering, is she going to stay on track with what the Fed has been saying? Or are we going to hear something different given what's going on in the job market and the stock market?
Well, I think, Susie, it's actually a great question. I think we will see more of the same in terms of the recent communications. I mean, I think the Federal Reserve has done a good job of trying to communicate to the market that they are looking, for example, well beyond the 6.5% unemployment rate, which we are close to now in terms of thinking about tightening. I mean, we mentioned the last time I was on this show, Susie, that the Fed was going to be very slow and deliberate in their tapering program, and so I think that still is the case. I think the hurdle to deviate from current policy is high. I think today's numbers may raise an eyebrow, but nevertheless, they would have to see corroborating evidence, both anecdotal and in the data, for them, I think, to deviate from their present course.
I know you're an economist, but everybody has an opinion about the stock market. If the jobs number was not as good as expected, why in the world did the stock market rally as much as it did today, do you think?
Well, I think part of that, Bill, is really the association, at least in some investors' minds, between the potential to slow the rate of asset purchases by the Federal Reserve and just global monetary liquidity with a formative stock market. We went into the year more guarded than in the past several years with respect to our long-term equity outlook. That still remains the case. But you know, any day, it is ironic that we're in an environment that seems to be where weaker than expected growth numbers can be associated with stronger equity returns.
All right. Well, we're going to see what happens next week. Thank you so much, Joe.
Thanks, Joe.
Joe Davis, Chief Economist of Vanguard. Have a great weekend.
Still ahead, why Californians who are thousands of miles from the harsh winter weather in the east are now also starting to feel a chill of their own. The White House today warned Congress that the government could start missing payments on its bills soon after February 27th. That is, if lawmakers fail to raise the limit on public borrowing. Back in October, Congress suspended the cap on borrowing until today, February 7th. Now the Treasury is taking extraordinary measures to save money and avoid breaching the debt ceiling. But starting today, Uncle Sam suspended sales of U.S. Treasury bonds to state and local governments.
Well, another kind of limit is affecting residents of California. They're being asked to power down on their use of electricity. Jackie DeAngelis explains.
More trouble for California, not just short on water at the moment, but also low on natural gas. In California, you typically see this in the summer when air conditioners are running on high, but right now it's happening because of unseasonably cold temperatures across the country. In fact, residents have been urged to voluntarily cut their electricity use to help out. That means turning off lights and electrically powered heaters. The alert expired last night, but it's not clear on whether more usage orders will come. All this coming after California has increased its nat gas usage since a decision last year to close a key nuclear facility. According to a 2010 report, 53% of California's power comes from natural gas. Nationwide, natural gas production has dropped roughly 1% last month, according to research firm Bentech Energy. But experts say that nationwide supplies are still fairly robust. Part of the production slump can be attributed to the cold itself. Chesapeake Energy, the U.S.'s #2 nat gas producer, has said that unusually cold temps have hurt its output. That as demand surges. But after hitting a 4-year high recently, natural gas futures have declined slightly today, now just under $4. Still, experts say that the forecasts are calling for the cold weather to last, and that will keep demand high. So for right now, Mother Nature still supporting these natural gas prices. For Nightly Business Report, I'm Jackie DeAngelis reporting from the NYMEX.
Elsewhere, Apple purchases $14 billion of its own shares. That's where we begin tonight's market focus. CEO Tim Cook told the Wall Street Journal that Apple initiated that buyback in the 2 weeks after its quarterly earnings report, taking advantage of the stock's drop the day after those results. Activist investor Carl Icahn weighed in on that repurchase. He took to Twitter, writing, Google at 19 times 2014 estimated operating profit. At the same multiple, Apple equals $1,245 per share. Ridiculous. Keep buying, Tim, says Carl Icahn. You still have $145 billion in cash. Shares rose more than 1% to close at $519.68. And Cigna was one of the day's biggest losers after the insurer posted weak quarterly earnings and a disappointing outlook. That company said that costs in its private Medicare businesses were higher, which might continue into this year. And that pressured the stock. Those shares tumbled by 9%, closing at $77.47.
Shares of IBM rose on report that it might be selling its semiconductor business. Big Blue has been spinning off some of its business units. It's all part of its push into cloud technologies. Just 2 weeks ago, IBM agreed to sell its low-end server division to Chinese PC maker Lenovo. The stock closed at $177.25 today, a gain of 1.5%. Expedia was the biggest gainer in the S&P a day after posting better than expected earnings. The travel site operator reported a 21% jump in gross bookings. Its deal with rival Travelocity also helped boost hotel room sales. Other online travel agencies, including TripAdvisor, Priceline, and Orbitz, also rose a lot on that report from Expedia. Expedia was the big winner, though, gaining 14% to $74.45.
GoPro has filed for an IPO. The maker of those tiny high-definition video cameras that a lot of skiers and hikers attach to their helmets to record a first-person look at the action has filed paperwork to begin selling stock to the public. Here comes GoPro.
And maybe one day GoPro will grow up to be a big player like Google. The search giant became the second most valuable company in the S&P today, passing ExxonMobil for a market cap of just under $400 billion. Still, Apple is the biggest, worth nearly $460 billion.
Just amazing. Well, our market monitor guest tonight likes to buy stocks that are the innovative part of the stock market, the high-growth companies, but also high risk to some degree. Mark Lehman is president of JMP Securities, an investment bank based in San Francisco. Mark, how are you doing?
Good. Thanks for having me on the show, Bill. I appreciate it.
You're an individual stock picker, but overall, do you see this market going higher? What did you make of the volatility this week?
I thought it was an interesting bit of action this week. Clearly, we had a tough January, which surprised a lot of investors. I think the consensus, obviously, going into 2014 was that bonds would be weak and stocks would probably continue to be higher. And that's obviously not what happened in the first part of the year. But fundamentals were somewhat decent this week, and I think investors really saw opportunities for some equities. And some of these high-growth companies that we're about to talk about really put up stellar fourth quarters and really are the shining stars of the market. And we see that continuing through 2014.
I think it's really interesting, your list of companies that you're going to talk about, Mark, because most of them have gone public a year ago or less, and you already are raving about them. So let's go down your list. The first one is Tableau. The ticker symbol here is DATA, D-A-T-A, and it's trading on the New York Stock Exchange. It went public a year ago. Tell us why you like this and why investors should put money in it.
Well, it's playing in a huge market, data and data analytics, and it's a market that really hasn't had a lot of innovation over the last few decades. It's a terrific product. It's a large growing market. We see that as about a $13 billion market now growing to about a low $20 billion market in the next 5 to 6 years. They have a very small market share. They're growing it very, very rapidly. And if they get their natural market share, this stock, which albeit being expensive, and you can see has done quite well since it's been public, will continue to do well, gain market share, and we think will be a winner.
Here's another one, Workday. They're in the human resources and finance business. That's a pretty competitive field.
It's a big field, and the ERP market is one that has a lot of incumbent players. The management team, Dave Duffield, was a big executive at PeopleSoft, which we all know, and in 5 years there, he grew the company to get 5% market share. If he does the same thing here, he's competing against incumbent players like Oracle and SAP, who combined have a $250 billion market cap in all the businesses they have. And if they get their natural market share, as they are also growing about 100%, this could be an extraordinary company. It already is. But be it an expensive company, if they gain that kind of market share, this stock's going to keep going higher.
Mm-hmm. As you've been saying, if this, if that. These are risky stocks, and they're not for people who like to sleep at night easily. Let's talk about your next one, Aratana. I hope I'm pronouncing that right. Therapeutics. Right. This pet. It's a company that's dealing with healthy pets, right?
Well, healthy pets, and as we all know, pets aren't always healthy, and we also know that people are going to extraordinary lengths to make sure their pets stay healthy. And if they do get sick, they're going to some other lengths to make sure that they get back to being healthy. That is a market that has grown absolutely in recession, in good times and bad. The pet market has never stopped growing in the last 30 years. The management team is stellar. They've got an ample capital to grow the company. They also, something we really should pay attention to is when you take a life sciences company that's focused on the human market, the product to get to market takes hundreds of millions of dollars to get to market. When this company takes products that are going to go to the pet market, it takes tens of millions of dollars to get to market. So the cost to get to market is lower. You have a very, very wide open playing field. They are the number one player in that market, and I think great things are ahead of this company.
Quickly, all three have done very well the last year. Are they vulnerable, though, if there is a definite market downturn?
There's risk and there's reward, Bill, as you know, and these stocks have done extremely well, and they're also trading at premiums to the market. But with their growth, I think buying a full share today, putting your all your dollars to work tomorrow, probably not a good idea. But these are the winners. These are the companies that we think are going to do extremely well. Okay. JMP has followed these companies, obviously, since they've been public, and they've done nothing but exceed their expectations since they've been public.
Any disclosures on your part?
We've done investment banking work for all three companies proudly, and I don't own the stock personally, but I do think these stocks are going higher.
Mark Lehman, president of JMP Securities. Thanks for joining us tonight.
Thank you both.
And coming up on the program, meet the man who had a craving and used his hunger, hard work, and a little bit of luck to turn a small chocolate shop into a sweet success story. We aim to end this Jobs Friday in good taste, the kind a chef would appreciate. With a week to go until Valentine's Day, the Godivas, Lintz, and Ghirardellis of the world know business will tick up. But one small company, Bridgewater Chocolate, is hoping to take a bite too. It's the bright idea of a Swedish chef who makes it his business to cater to the American palate.
So the world was open.
Welcome to Eric Landegren's world. Handcrafted peanut butter patties, turtles, toffees, and caramels. Just the kind of American-style treats you'd expect a European chef to sniff at.
We love to come here and tell the American public what they should like. Well, if 300 million Americans would like to eat peanuts, I'm going to work with peanuts.
Landegren's Bridgewater chocolates were more of a local curiosity when he began selling them at the Village store in tiny Bridgewater, Connecticut back in 1995. The chef came to New York from Sweden in the 1980s.
Very first machine I ever had.
He had never dabbled in chocolate until he moved to Bridgewater, where he worked as a personal chef for one of Wall Street's best-known deal makers, Peter May. When his boss bought the store, rescuing it from bankruptcy, Landegren suggested chocolate, high-quality chocolate, could bring in new customers.
Superb business concept, yet it failed miserably.
The confections were considered a little pricey, but things changed after a New York radio host called to ask if Bridgewater shipped boxed chocolates.
All I wanted to do is sell more chocolate. And of course, I immediately says, yes, we do, in fact.
Little did he know she would rave about Bridgewater chocolates on the air.
We got slammed and had about 100 phone calls that afternoon. And I had no idea how to go about it.
Everything's packed on ice.
Andrew Blauner, Peter May's son-in-law, developed a craving for the chocolates.
I bring it to work where I worked, and we put it on the conference room table and be devoured in 30 seconds. And then I look at my bill for my credit card, and I would see it was never charged. And so I said, this is not a good business situation.
In 1999, Blauner teamed up with Landegren, transforming the company into a serious business. One key change, marketing the chocolates in their handsome hinged boxes to corporate customers.
We can customize the inside lid.
And Blauner moved operations from the cramped basement of the Bridgewater store to a big warehouse in an industrial park nearby.
He bought this machine that was 55 feet long. I mean, you cannot put this anywhere, and you need to have a facility. Where were you going to put it? And he said, well, I was just going to put it in my basement.
It's absolutely true, everything he says, because when I am just me, it's pretty hard to be me. Andrew makes it really easy for me to be me.
Which makes it very hard to be me. But yeah, exactly.
The duo have turned Bridgewater chocolates into a multi-million-dollar business. Sweet success in a crowded, competitive field.
We have always made money, and the goal has always been to be America's chocolate. We want to have a box of Bridgewater chocolate on everybody's dinner table for every special occasion.
And more than 60% of sales are holiday gifts for those special occasions, most of it ordered online or by phone. Valentine's Day is their next busiest time, accounting for more than 10% of his business.
Great story. Well, she's only been on the job for 3 weeks, but already the new chief executive of GM is getting a lot of attention. Mary Barra, the CEO of GM, the first woman ever to head up a major automaker, has just been named the world's most powerful woman in business by Fortune magazine. Coming in number 2, IBM's CEO, Ginny Rometty, and third was PepsiCo's Indra Nooyi.
And finally tonight, the 2014 Winter Olympic Games in Sochi, Russia, have already begun, and this year's gold medals will be among the largest in Olympics history, but not the most expensive. A gold medal from this year's games is worth about $581, down from the record value of $706 for a gold medal back in the 2012 London Olympics, due in part to the decline in gold prices.
But make no mistake, to all those athletes, a gold medal, priceless.
Priceless.
Right?
You're absolutely right. That's Nightly Business Report for tonight. I'm Susie Guerra. Thanks for joining us. Have a great weekend.
I'm Bill Griffith. Do indeed have a great weekend, everybody. We'll see you again on Monday.
Nightly Business Report has been brought to you in part by
TheStreet.com. Founded by Jim Cramer, TheStreet.com is an independent source for stock market analysis. Cramer's Action Alerts Plus service is home to his multi-million-dollar portfolio. You can learn more at TheStreet.com/NBR.
I'm Susie Guerra with the Nightly Business Report news brief. American businesses didn't do much hiring in January. Only 113,000 new jobs were added to payrolls last month, way below forecasts. The record cold weather getting the blame for the weak number. But on the bright side, the unemployment rate fell one notch to 6.6%. Surprisingly, on Wall Street, stocks ended higher for the day and the week. The Dow shot up 165 points, the Nasdaq jumped 68, and the S&P added 23 points. Google passed ExxonMobil today to become the second most valuable company in the U.S., but Apple is still number one by a long shot. And just 3 weeks on the job, General Motors CEO Mary Barra was named the most powerful woman in business by Fortune magazine. Be sure to tune in to Nightly Business Report right here on your public television station.